Okay, I think we are live now. Let me make sure everything is set up properly. We have a little bit of a delay, but geez, taking a long time. I think we're live. Yes, we are. Okay, testing. Okay, I think we sound good. Okay. We'll just wait a little bit while we let people filter in. And then we'll get started. Okay. Make sure I have everything ready. Okay, if the sound is off, please let me know. And I'm just going to make sure I have all my tabs the way I want them. And then we'll get this show on the road. Oops. Okay. Okay. I think we just go ahead and start. Okay. So, this week's company, I'm really excited to show this company. It was actually pointed out to me by one of my viewers. Shout out to Hokage. When I first looked at this ticker, I always throw it into my discounted free cash flow spreadsheet and put in a few basic assumptions, and it looked too good to be true right off the bat. So I was like, okay, I have to do a deep dive on this company. It is Molina Healthcare, and you may have to bear with me a little bit. My stockanalysis.com, it has not been doing very well today, but so hopefully it doesn't crash on me again. But you can see that this company had peaked back in 2024, February of 2024. And since that peak, it has lost over 50% of its value. And it has had, we're going to go into more of the details on this, but it's had some struggles with profitability. And because of that, the stock has dropped off significantly. So we're going to look into, has the market overreacted? I'm going to be making the case in this video that yes, the market has severely overreacted on this company. And so I'm going to start building a case for that. So the way I typically value a company is by using my discounted future free cash flow valuation spreadsheet that I built. It is for free. You can find the link in the description of my videos if you are interested in downloading my spreadsheet, or you can copy it and tweak it, build your own, whatever you want to do. It's completely free. But the way it works is I'm discounting all future free cash flows to build out the current fair share price based on those future free cash flows. And I care about cash flow, free cash flow, because that is what the company actually has available every year to reinvest, to return to shareholders, to expand, to pay off debt. So free cash flow, I have found, is the most important single number that I care about as an investor. So I go to great lengths to try to project future free cash flow. So as a value investor, I am solely forward looking. I'm trying to see, how is this company going to do in the future? I'm not so focused on the current ratios, the current PE ratio, the current price to book ratio. Those are nice like initial indicators to kind of get me started looking at a company. But in reality, like the more growth of profit and free cash flow and revenue, the better. So I'm a value investor, but I'm looking for growing companies, and I'm looking for companies that are also undervalued, underappreciated. So sometimes a company doesn't have to be growing as much if it is cheap enough to justify the current share price, or if the current share price is not justified because it's so cheap. So in this case, we've got a company that is incredibly cheap. Now, this spreadsheet has there's several assumptions I make here. There are 7 assumptions, and we're going to go through them, but they can broadly be broken up into 3 categories. Top line revenue growth is one big assumption. The profitability is another big assumption. That's the free cash flow margin. And then my discount rate. What minimum return do I want on my money every year? And so I use 8.35 currently. That is about that's the risk-free rate plus the equity risk premium. The risk-free rate being the 10-year U.S. Treasury yield. That's the yield that I could get for free. It's a little over 4%. And then the equity risk premium is a little bit over 4% as well. And that is the extra risk associated with investing in the stock market. So I want a minimum of an 8.35 return. So that's one assumption. The next assumption is revenue growth. So I'm assuming, my initial assumption is always just 2% revenue growth. I want to see, like, if this company is just going to keep pace with inflation, how does the stock price look in that case? And then if it looks really strong, or if it looks reasonable in that case, and maybe it's a high growth company, then I'll look a little bit further. But that's always my initial look. If it's just going to grow at 2%, how's the stock price look? And then for the free cash flow margin, I use past performance for my initial look as well. So on average, over the last 5 years, their free cash flow margin has been 5.17%. I used 4.5% here because I make some adjustments down here to the free cash flow for R&D, CapEx, acquisitions, and stock-based compensation. In this case, I'm just adjusting it for stock-based compensation, which brings my new average to 4.88. And so I'm using 4.5. And so this is my initial look. So that's my projection right here. This is the one that takes into account all of these assumptions. We're going to talk a little bit about these analyst assumptions here. But based on my projection, there is a 200% upside on top of my 8.35%. So what this tells me is that the market believes that this company is going to way underperform their past performance, and they're going to way, in terms of profitability, and they're going to way underperform 2% revenue growth. So way underperform. So this is the fair share price of 531. Their share price is currently 178. So when I see something like that, I'm like, okay, so this has got to be too good to be true. There's some assumption here that I'm making that is just too optimistic. So the first stop for me is on stockanalysis.com. I like to go to the forecast tab and look at, and this is where it looks like it's going to crash on me a little bit. We may have to skip this part. Oh no. Okay, so we can't. So basically, stockanalysis.com, when it's working, I don't know why it's down right now. It gives me an aggregate of many analyst projections for future revenue growth. And I think I've already loaded that in here. No, I have not. This is not the revenue growth for this company. So, okay, we're going to have to come back to that. So skipping the aggregate of analyst opinions, the next thing I like to look at is I like to go to Morningstar Equity Analyst Reports. They have really detailed write-ups on what's going on with the company, why it's down, what their future prospects are. So that's my second stop. But before I go there, let's talk a little bit about what this company does. So just specifically, I realized I didn't go into the details on this company. Molina Healthcare provides managed healthcare services to low-income families and individuals under Medicaid and Medicare programs through state insurance marketplaces in the United States. It operates in 4 segments: Medicaid, Medicare, Marketplace, and other. The majority of this company's revenue comes from Medicaid, and we can see that as well if we go to their this is their most recent annual report. So this is in 2024. This is their last full annual financial report. They had almost $5 billion. This is in millions. This one must be in thousands. They had $5 billion, I believe, in revenue. Sorry, let me just make sure. Will the financials tab work? The financials tab won't even work. Okay, no, it did. Okay, so they have 42 billion in revenue, 38 billion in 2024. And when I go here, let's see, this is membership by segment. Okay, sorry, I was looking at the wrong thing here. This is where it's talking about revenue. So 30 billion came from Medicaid. Sorry about that. 5.5 billion came from Medicare. 2.5 billion came from Marketplace. So the vast majority of their revenue is coming from Medicaid. Just so we can see, the type of company that this is. So the main thing to consider here, so if we scroll up a bit, they say how we assess performance. We derive our revenues primarily from health insurance premiums. Our primary customers are state Medicaid agencies and the federal government. The key metrics used to assess the performance of our Medicaid, Medicare, Marketplace segments are premium revenue, medical margin, and medical care ratio. So this is the key ratio right here, medical care ratio. What percentage of the premiums can they keep? And how much of it do they actually have to spend on care? Now, there is a bunch of regulations here. So the medical loss ratio, this is the ratio that they're talking about. They are required to spend at least 85% of total revenue on services. So that means their maximum that they can have for administrative and profits is 15% of all of those premiums. So if we look at this section down here, we can see this is their medical care ratio. So for Medicaid, they were 90% in 2024, and they were 89% for Medicare. But honestly, I don't put too much stock in the Medicare and the Marketplace. Like, this is the bulk. Medicaid is what I'm really looking at. And the trend on Medicaid is not good for this company. 88.7 in 2023, 90.3. The higher this number goes, the worse. So the worse for shareholders, that is. That means they're having to pay more and more to patients to cover their care. So good for the patients, bad for shareholders. Okay, so 90%, they could be making more. They could be making 85. They could be 85% here. So just wanted to show the trend and why this company is struggling. So like I said, I really like to look at these Morningstar. Oh, sorry, wrong tab. These Morningstar analyst reports. They give just a really nice breakdown. So right here, managed care organizations hit with weak Medicare Advantage initial rate notice and new risk rules. After hours on January 26th, the Centers for Medicare and Medicaid Services released its initial rate notice for the 2027 Medicare Advantage program, which included a flat overall rate increase rather than 5% increase in 2026. So why does it matter? Reflecting another regulatory crackdown on key MCO marketing, big MA insurers, CVS, Humana, United Health. A lot of these companies are falling. In May 2025, we incorporated lower M&A margins into our models due to potential new MA regulations related to aggressive risk assessment in this population. We did not anticipate a flat rate environment. More positively, investors should note this initial notice is typically not finalized until April, meaning that the rate may rise. CMS already foreshadowed a potential 2.5 increase from its initial draft. So the bottom line, while we are not changing our fair value assessment on 4-star MCO insurers because these rates have not yet been finalized, let's see, specifically, we currently assume that MA rates will increase in the mid-single digits over the long run. So a permanent cut in MA rates to about 2.5% and further pressure on MA margins could trim roughly mid-single to low double-digit percentages off of our fair values. So as more information comes out, they're saying they may even drop their fair values a little bit more. If we scroll down a bit more, they have a breakdown for like the bull thesis and the bear thesis. Molina could become an acquisition target for one of the larger MCOs. So we've got some acquisition possibilities. Molina's end markets appear countercyclical, or at least recession resistant, which could make it a good pick for economic downturns. And states have increasingly outsourced Medicaid programs to NCOs like Molina because they help reduce the uncertainty that comes from fluctuating utilization patterns. And the utilization is one thing right now that is particularly high. When we go back to that page right here, 90% in 2024, and it's increasing. And we're going to look at what it is, what the trend is for 2025. This is the utilization. As utilization goes up, they are having to spend more and more on services. So if the trend in the country is that people are utilizing care more and more, then and it is cyclical, then these companies make less money. That is essentially what we're seeing here. So, okay, bears say Molina continues to face more competition as its Medicare peers and large commercial insurers aim to expand. Molina, oh, sorry, I just saw your comment, Hokage. Something to keep in the watch list. Oh, RCL and CRM could be a good value as well. Hey, Hokage, thank you for pointing out this company to me, by the way. I think you're gonna like what we're gonna value this company at. It's pretty crazy. I do appreciate you pointing this one out. And I did look at Oracle as well. I thought this one looked a little bit better, honestly, than Oracle. Or I actually don't know if the company is Oracle, but the ticker ORCL. I can't remember the company name. Okay, they also give a narrow moat to this company, which is good. Obviously, a wide moat is best, but it just means that they have some pricing power. And they have, let's see, what is their moat related to? Usually they give a synopsis for the moat. But anyway, the why it matters to us is we believe going forward that they will generate returns on invested capital above its capital cost. So it's just good for us. Oscar. Oh, Oracle is Oracle. Oh, I was thinking of Oscar. My bad. You did also point out Oscar. Okay, so I still need to look at Oracle. Okay. So how are we going to estimate future revenue growth? That's the first thing that I want to test on my model. So I had initially, Hokage, I don't know when you tuned in, but with our initial assumptions using historically average free cash flow margin and 2% revenue increase, the upside is insane. Please ignore these, by the way. I can't get stock analysis to load the analyst projections, so these are not accurate. Just focus on my projection right here. Right now, a 200% upside, given these assumptions, just like this is average historical progress, basically. And actually, if we use true past projections, so past revenue was over the last 5 years, they've averaged 16% revenue growth. Over the past 5 years, they've had 5% free cash flow margin. So if we use the past revenue, then there's even a higher upside. Anyway, yeah, Hokage, I think something happened with your comment there, but I don't know what you're saying. Okay. So first thing I want to address. Oh, tried pacing 2 years. Sorry. Okay. First thing I want to address is the revenue growth. So on this Morningstar analyst report, if we scroll down a bit further, they talk about, keep going down, fair value and profit drivers. Okay. We estimate Molina's fair share value at 311. We expect 7% revenue growth and 5% earnings per share growth compounded annually over the next 5 years. So 7%. This is as of the 5th of December in 2025. That's when this guy did his report. So 7% was the expected growth. Let's see. We suspect Molina will have an easier time meeting or even exceeding its long-term earnings growth rate of 13 to 15% compounded. And even several years after that, as margins should improve towards management's pre-tax margin target of 4 to 5% over time from under 2% expected in 2025. So this is the issue right here. So in 2025, they've been dropping a lot because their pre-tax margin is incredibly low because utilization rates have been going up. Thus, their medical loss ratio is above 90%. And as a result, they're getting less than 10% of those premiums to spend on administration and then profit. So currently their profit is under 2% because their margins are getting compressed by that utilization. They see a long-term average of 4 to 5%. So their current margins are very low. That's over the last couple of years. They are expected them to basically double on average over time. So this would be like the midpoint. Okay. Let's see. Risk and uncertainty. We see very high uncertainty. So this is I would call this one a high risk investment because we can model all we want, but because there's a high degree of uncertainty, as new information comes out, it could completely trash our model. So all we can do is we can just do the best we can with the information that we have available. So just keep that in mind. Companies like these, I believe, should only be small percentages of your portfolio because of the high degree of uncertainty. So just want to make that disclaimer straight away. Okay, Hokage says the 2026 forecast is 12.4%. That's for the high, 4% for the average, and losing 6% for the low estimate. Why is your stock analysis working and mine is not? That is so frustrating. I still can't get it to work. Well, if I remember right, all of the analysts were projecting losing revenue in 2025. I don't know by how much. We'll say minus 10%, just to have like a spread of assumptions here. Or no, I'll do 15, 10. Sorry, that's actually not right. We'll do 7, 10, and 15. Hokage told me that for 2026, we have 12, 4. Oh, wait, is this right? I have this in here? I actually had this in here. Anyway, let's just stick with this then. We're going to go bearish for 2025. Based on that spread of assumptions, the upside is still huge. But okay, I need to get back on track here. We're focusing on revenue growth. I have 2% for years 1 through 5. That seems to be actually too low. So I actually have too low of a number. Based on the Morningstar analyst report, they are assuming for the next 5 years, 7% revenue growth on average. So I think in my mind, this is fine right here. These 3 cells, this is the revenue growth rate for years 1 through 5. This is the perpetual growth rate, and this is for years 6 through 10. So I kind of have these out of order. But I'm just assuming 2% revenue growth going forward. I think that is completely conservative. And Hokage is confirming that 2025 was actually 21%. Okay, so I've lopped it off. I misremembered. I thought it was negative in 2025, but they're actually increasing their revenue quite a bit. It's just that their margin is very low in 2025. In fact, if we look at 2024, it's actually 1%. So we can see margin in 2020, 9.6. 2021, it was 7.3. 2022, 1.8. 2023, 4.5. And then and then 1% in 2024. So the average here is 4.8. So the last 5 years is in line with their average, but they are experiencing short-term pain right now. So if my revenue assumptions are reasonable, then what does that mean? I need to be dropping the free cash flow margin. So if hypothetically I drop the free cash flow margin down to 1.5%, that is about their current profitability. That puts the current share price as fairly valued. Okay. So the question, and Hokage just weighed in here. He's telling me that I need to have 21, 15, and 8. Wow. I would like it to be green. I don't know which green. Hey, there we go. Okay. Using my assumption though. So here's the analyst spread based on a 1.5% free cash flow margin, and then using the analyst projections for future revenue instead of my own, then the highest analysts give me a 71% upside and the lowest analysts give me an 8% downside. So basically fairly valued if the most pessimistic analysts are correct. And this is so I have this cell right here is the free cash flow margin growth. I've built in zero growth. This is forever. If I put in 1.5% margin forever, that is, sorry, I keep scratching my nose. That is at that's at historical lows. I have an historical low margin being projected out into infinity, and then it puts the fair share price at today's level. So I find it incredibly unlikely that this is putting the bar too low. So I'm seeing a significant upside with this stock. And then I want to put forth another piece of evidence. So I went to the most recent Q&A session on their most recent quarterly report. And you can see there's lots of questions here, but I found one that was the most interesting one to me. Let me see if I can get back to it. Sorry. Okay. Here's the question. So Joshua Raskin says, thanks, good morning. When you look at the early view of 2026 being similar to this $14 year, I think they're talking about earnings per share here, would you characterize that as a new baseline from which you grow and realize your embedded earnings going forward? Or do you view that as an abnormally depressed and we should expect above average growth for a couple years as margins get back to targets in all three segments? So he's basically asking, if we look at our view of 2026, is this our new baseline or is this abnormally depressed? Here's the answer. Okay. Now the question everybody asks, how much time? Oh wait, sorry. I'll just read it from the beginning. Whether we're taking the full year of 2025 in Medicaid or an annualization of the second half at 13 with the items of upside we mentioned, we certainly believe that rates will come back into balance with the medical cost trend over time. So right now the medical costs are very high. Now the question everybody is asking is, how much time will that take? Are we going to be at these depressed levels for a long time, or is it going to rebound over the next year? Like, what are we looking at? He says, we don't know. We're not forecasting that, but next year we are assuming that rates are in excess of the trend, modestly in excess of the trend, and that's a good jumping off point. But what we do believe, we have not changed our long-term outlook on margins of the business. In the first half of the year, we had 3.8% pre-tax margin, and even that was below our long-term target of about 4.5 for the business. We believe over time these things come back to target margins. The market in Medicaid needs 300 to 500 basis points to break even. Just to break even, we've consistently operated 200 to 300 basis points better than competitors in all of our markets. We need a fraction of what the market needs in order to get back to target margins. And then he says he wants to build on that. He says it sort of implies that so he said that people did the math. The implication is that next year, the whole company will run at a 2% margin. So that's a slight increase, maybe 2.5 on Medicaid, which in both cases is significantly below our longer outlook of 4 to 5 pre-tax margin, or 4.5 at the midpoint. So it certainly implies that next year's margins are reduced with a lot of growth potential as this rate cycle normalizes. So all of that to say is that their current margins, which is going to be very related to their free cash flow margin. And we're going to look in a second how they're spending their cash. Margins are going to improve according to the cyclical trend. So right now they're at 2 to 2, we'll say 2. The midpoint is 4.5. So what I'm seeing is the average going forward should be at least double what their current free cash flow margin is. And so just to put that in perspective, I've got 1.5 in there. The average free cash flow margin over the last 5 years is 4.8, and it's showing fair share price. If I just double it, if I say that their free cash flow margin is 3%, so they're twice as profitable in terms of free cash flow, which is still lower than their last 5 years, then we're looking at a 100% upside. So this fair share price is incredibly sensitive to this free cash flow margin sell. And so we have to really put a lot of care into how we're estimating this. And it's incredibly important to put the bar sufficiently low. So another thing that I think could be useful is on this page. This is going back to the Morningstar Equity Analyst Report. They also give free cash flow projections. So let me just scroll down a bit. Okay, so right here, they give revenue growth projections. This is as of December. Their December revenue growth projections was 6.6. That's about, they were saying 7%. Looks like they rounded up. But they also give free cash flow margin to the firm. So the 3-year average, so I'm looking at a 5-year average, but they're saying their 3-year average is 2.3. They're saying going forward over the next 5 years, they're actually going to be losing free cash flow in 2025 and then slowly building back. So over the next 5 years, this company Morningstar is projecting 0.4 free cash flow to the firm. So I think this right here is what it could be pushing their valuation so low, is this very low free cash flow margin number. That being said, even with this free cash flow number, Morningstar is still projecting their fair share price at $301 per share. So their current share price, $178. So not quite 100% upside according to Morningstar, but fairly high. Also, I should point out, I don't know exactly how they are calculating free cash flow to the firm. That is technically different than free cash flow. They may be calculating their free cash flow differently than I am. Let's actually take this opportunity to go to their free cash flow statement. If I can get it to load, that is. Hokage asked, do we need the 2025 estimate? So it's not technically, it's not uploaded onto Stock Analysis though, is it? Like their latest financials? Let me see. So on their most recent, this is their most recent transcript. If I go to their financials on here, see, they only have their trailing 12 months. They have not made public their full year of 2025. So for 2025, the estimates that are currently out there are probably really accurate because they have 3 quarters of actual data. And now people are only projecting that last quarter. So only a quarter of that number can move a little bit. So for the full year, the analysts are probably really close on their estimates. So this 15% revenue growth is probably right on the money. So yeah. So I'm actually a little bit surprised here that they are showing for 2025 negative, and then for 2026 0.3. It's very interesting to me. I'm just not sure how they're calculating their free cash flow to the firm. And of course, I cannot get the Stock Analysis to load. That is so frustrating. Right when I go to stream, it doesn't load. Dang. So if we put in 6.8, like Morningstar projects, we put in a 1% free cash flow margin into perpetuity forever, right? This is forever. Then we're looking at a 16% downside. So, going back to this, oh dang, where is it? Sorry, going back to the earnings transcript, how they're talking about how they view the future of this company. They're saying that right now, 2% margin should be 4 to 5% at the midpoint. So some years it will be higher than 4.5, some years it will be lower. That's where we're at right now. So I find it way too conservative to keep this at 1%. I think if we put in, so this is 5 years of free cash flow margin growth. Say they grow their free cash flow by 0.5% every year for the next 5 years. That means at the end of my projection period, they're sitting at 3.5% free cash flow margin. And then 3.5% will be the average going forward after 5 years. I think that's fair given that the last 5 years, which includes 2 low years, by the way, is 4.8. So I'm still assuming, like, even when I build in this margin growth, I'm still saying that their final, like their perpetual margin going forward is 3.5. It's still below their historical average. So given this set of assumptions, I'm seeing huge upsides. So my conclusion for Molina Healthcare is that the market has priced this company way too low. And I would like to go to maybe I can use like Yahoo instead. Yahoo Finance. Let's see. Okay. So on Yahoo Finance, if we go to the 6-month view, or sorry, we go to the 5-year view, they had a big drop off. This was in June of 2025. So my case is that this big drop off was overblown. They should be up here still trading between this range of, 3 to 400 at least. Now, I am not making any predictions on how long it's going to take the market to price this company higher. I'm not making any projections on that. I don't do timing on this channel. All I do is I look at the projections of future free cash flow and what stock price that implies. And my hope is that eventually the stock price reflects its actual value in terms of free cash flow. Now, a lot of things can change in the meantime. The company could come out that they're committing fraud, like on their financials, right? And then everything goes out the window. So we have to always react as new information comes out. But with the information available today on Molina Healthcare, it appears to me to be massively undervalued. So this week, I'm going to be putting $200 into Molina. I always put $200 into a new stock every week, and then I put $50 into an existing investment that I have that has dropped in value perhaps, and it appears to be extra undervalued, more undervalued than when I initially bought in. And there are a lot of companies in my portfolio that have dropped unexpectedly recently. Adobe being one that I really like. I have not looked into, it must have had a bad earnings report. I was trying to look at it on Stock Analysis. And also PayPal has also dropped quite a bit recently. Both companies were, last I looked at them, incredibly solid in terms of free cash flow and very low debt. But unfortunately, I just cannot get Stock Analysis to load right now. So unfortunately, we're going to be cutting this segment of the stream short. I cannot do another analysis. Even when I type in PayPal into my spreadsheet, it's just not able to pull the information from stockanalysis.com. That is, I built this spreadsheet to pull information from that website. So when that website's having trouble, which temporarily it is, then I can't really use my spreadsheet. Strangely, it's working for MOH still. I don't know why, but yeah. So this week, I am not able to analyze PayPal and Adobe. Those were going to be the two targets, though, that I was going to look at to evaluate to see, do we want to put a little bit more money into those companies, or have they dropped for a really good reason? And maybe they're still undervalued, but maybe they're not more undervalued such that I would want to put more money into them. So normally that would be this portion of the stream. I can't really do that. So at this point, I like to open up the floor and see, do any of you guys have companies that you want me to look at? Hokage already brought up a couple. Oracle and CRM. So sadly, I don't know how much I'll be able to do on these, but let me try. Salesforce. I knew that. Yeah, sorry guys. This is these are my tools. I'm not very flexible with my spreadsheet. I have not built the spreadsheet to do valuation from other websites. So we may have to call it. We may have to call it here, unfortunately. But yeah, so for next week, I'll put a pin in it. For next week, I'm going to be looking at Adobe and PayPal. I'll already have done my analysis before we stream next week, so I'll have an answer. Am I going to invest more into Adobe and PayPal, or is their future outlook significantly worse now, and maybe they don't deserve more investment, or maybe they even deserve for me to pull out. I don't know yet. Hokage said it looks like Q1 in 2026 is a bit bearish for money necessity ETF. That's right. Yeah, a few of my holdings have really not done well. However, I've had a couple. Some of my energy companies have done really well. So I'm glad that I started investing in energy. And we are actually, so over the past basically few weeks, we've basically dropped back down to tying with the S&P 500. We were beating the S&P 500 for the majority of the time, but now we are actually tied with the S&P 500. We're only above it by 0.5%. So that's the thing with value investing, is you will have your ups and downs, but over the long haul, the goal is to beat the S&P 500. Now, these companies, I'm not trying to time them at the exact bottom. I'm just looking at when does the free cash flow make sense, and then I invest. A lot of times this is when companies are coming down a bit and that momentum carries a bit further. I don't try to time the market in that way. I'm just looking at, based on the projections, how do we look? So energy looking really solid. Both my energy picks, C&Q and VET, both up 16%. Dorchester DMLP, that one is actually sitting in my that's in the small cap folder, isn't it? Yeah. DMLP up 7.7%. So energy is looking really solid. Overall, my small caps are looking really good, except for WRLD, which we doubled down on. We put a little bit more money in because I looked into this company. I cannot find a reason why it has dropped in value. I can't. It's such a small company though, and it has such low volume that it's really easy for the share price to get pushed around by somebody, selling like, I don't know, 100,000 shares could really push the stock price a lot. Whereas, with NVIDIA, I don't know, millions of shares get traded every day because there's so much volume and it's a huge company. But with a company like this, it gets pushed very easily. So, this may end up being, if I'm going to look at PayPal and Adobe, but I may end up still putting a little bit more money into WRLD. But if we look at all of my different sectors, so we see that the small cap, low volume companies are up this year. These are all based on since January. These percentages here are all based on January 1st of this year, I believe. Tech is down a little bit. Healthcare is down. Consumer discretionary is down, and financials are down. And then everything else, all these other sectors are currently up in my portfolio. This one is my worst. Consumer discretionary is my worst category currently. The two Chinese companies are down significantly. Lululemon, which I should also look into. I need to look into Lululemon again, is also down 15% lately. It was looking really strong for a while, and I'm not sure what the latest is on that one. Airbnb down a little bit as well. So this one, consumer discretionary, is looking rough. And financials, consumer discretionary and financials. And wow, this one's not really affecting it much, WRLD, because it's only $7 in this particular pie. I have everything divided up by pies. But yeah, PayPal 30% down. That is what's dragging down the financials, because with this one, PGC is up 26%. However, this is only an $11 slice. So I have these two slices in here just to know how many financial companies I have. But the majority of my money for that company, because it's a small cap, is in here. So PGC up 26%. So that is financials. So it's a little bit misleading because of the way I have this organized, but I want to keep my small cap. I have a separate category for small micro cap companies that are also very low trading volume. I like to have them separately and with higher visibility, because I always want to be having an eye on them for opportunities, because the share price could get pushed around so much. Hokage, considering so many have changed directions, I believe it may not be the companies, but more like they're reacting to macroeconomic news. Yeah, you're probably right about that. That's a great point. So as the macro environment changes, it's important we don't overreact to short-term movements in the share prices. We need to make sure that we're continually evaluating the companies based on their discounted future free cash flow, not based on how much the stock price has moved in the last week or month or whatever. That's right. Yeah. Yes, indeed. Yeah. And then it could be a really good opportunity to put more into some of these companies that have actually dropped. So next week, we're going to look into some of these. For these two, if I remember correct, there are some antitrust things going on in China, and that has hurt some of these big monopoly-like companies. So that's the concern here. What's the word? Regulatory overhang is my understanding, but I need to look a little bit more into these. And then Lulu, I'm not sure. So yeah, I think that's all we got for tonight. Hokage, thank you for the suggestions. Sadly, stockanalysis.com is just it's not working for me tonight. I'm sorry. I'll on my own time, I'll look into both of these, Salesforce and Oracle, and then I will bring them back up next week, Wednesday, assuming everything is working. Yeah, I'm sorry, y'all. Just having technical difficulties tonight. But I am very excited about Molina Healthcare. With this conservative outlook, to me, it looks conservative. So 1% free cash flow margin, which is a little bit less than last year, 1%. But even if actually, let's make it negative. Let's make it negative 1%, like Morningstar had it. And then instead of increasing by, I want my end of the 5-year period to be 3%. So that means I need to increase by 4% over the next 5 years. So a 1.2, right? Or no, sorry, 0.8% increase every year. Yeah, 0.8 times 5 is 4. And then we're starting at -1. So at the end of our 5-year projection period, our perpetual margin going forward is 3%, just like before, but now we're starting at a lower point. We're actually losing free cash flow margin. But given that set of assumptions, I'm seeing a 100% upside. So the fair share price is, according to my projections, according to these projections right here, the fair share price is around $380 per share. I'm putting $200 into this company. So we'll see how it goes. Hokage, thanks for tuning in. I appreciate you, buddy. Good night. Yeah, the Friday video. Do you remember which video is coming out this Friday? I can't remember which one's coming out this Friday, but it'll be a good one. I hope you like it. Anyway, hope you tune in next time. See you. Oh, yeah. Goodbye, Hokage. Goodbye, everyone else who's watching, who's just lurking and not commenting. I hope you guys start commenting. Give me some companies that you want me to look at. I'm happy to look at companies. Tonight is an outlier night. I'm having technical difficulties, y'all. I swear. Normally, I would be doing... Oh, here we go. It's starting to work a little bit, but it's just so slow tonight. Something is going on with stockanalysis.com. But yeah, next time, hit me up in the comments. Let me know what companies you want me to look at. I'm happy to do a live analysis on some of these companies. Just a surface level analysis, not a super deep dive. Like I wouldn't be making a final recommendation to buy or sell live on stream without having done a bunch of research ahead of time. So just keep that in mind. And thanks for tuning in, y'all. I will see you next week, Wednesday, 7:30. I hope to see you there.